The October labour force survey painted a better picture on the labour market, but coming after a weaker read in September, we are effectively left with the same underlying story of a labour market that is gradually becoming less tight. Employment rose by 42,200 in October, above our forecast and the consensus expectation. This allowed the annual growth pace to hold steady at 1.5% on a 3-month average basis, which is around half a percentage point below the pace from 6 months ago. This slowing in jobs growth is coming against the backdrop of a broader growth transition in the economy. The jobs-rich care economy is cooling from recent strength, and the somewhat less jobs-intensive market sector is gradually recovering. Moves in the unemployment rate have been getting a lot of attention recently. Last month, a softening in conditions saw the unemployment rate jump just enough to round up to 4.5%. But in October, the unemployment rate fell back again, just enough to round back down to 4.3%. Once we smooth this volatility, we still see the unemployment rate is clearly tracking a gradual uptrend, ticking up 0.1% per quarter so far this year. This trend has been fairly broad-based across youth and adult cohorts as well, although the youth segment has been the driver of volatility in recent months. Now, while October's data was solid in isolation, it largely offsets a weaker print in September. So we are left with a reading on the underlying trend that is little changed from a few months prior. The labour market is gradually softening from a relatively tight starting point. We continue to expect a little more softening in labour market conditions ahead, with the unemployment rate forecast to reach a peak of around 4.6% in the second half of next year. For the RBA, a labour market that is not posing any material upside risks to inflation, nor deteriorating rapidly enough to cause major concern, will allow the Monetary Policy Board to remain squarely focused on inflation for the time being.